index will come up with nothing on it as well. It's 1:1 advances to decline ratio. Nothing very much happening there as well. Nifty 50 heat map gives you a quick sense of where we are starting, and then we'll pick it up from there. So what do we have? 40-point cut, 25,946. And you got about, what, 16, 17 names which are starting in the green. JSW is on one end of the spectrum in green. And, of course, IndiGo is selling off on the other end. Surabhi.
Okay, I was just looking at the stocks that Sonal was mentioning on the back of this Nomura view. Nomura is concerned about the rise in Henry Hub prices. And MGL and IGL source a lot of their gas, based on this. Not too much on the stocks right now. Mahanagar gas is down about just 0.25%. IGL is actually up about 0.5%. So not really showing up in terms of stock price concern, at least right now. Interglobe Aviation, 3% lower on the stock now. So let's see. The biggest issue is that is this a passing disruption or is it something more structural in nature? And we'll have our answers, I think, in the days ahead. Apart from Interglobe, the other stocks on the downside would be a Power Grid. Titan and HUL from the consumer space are seeing some profit taking. HDFC Life is down about 0.5%. Max Healthcare down about 0.5%. SBI Life also slightly lower. Let's look at the upside of the screen then. JSW Steel, like Nigel was saying, that now that we all know the deal contours, the details, it's not that bad at all. And perhaps helps the listed entity deleverage. So 1% up on JSW Steel. TCS is up about 1%. That was Sudarshan's intraday call for today. 1% up there. Hindalco is seeing some traction. HCL Tech and TCS, both actually up and about. So Tech is seeing some buying. And then there's JSW Steel on the upside. Everything else is very flat.
Well, that's right. Our colleague Yash had reported that that deal was in the works. And that deal actually has been announced. And now it appears, slice and dice everything. An EV of 53,000 crores. It's more favorable, actually, for the company. Explains why JSW Steel is up. What else is doing well? Spark, getting back to its winning ways, up close to around 4%. Big move is what we're seeing out there. Petronet LNG, favorable news flow coming in overnight. Maybe in the longer term with that deal that they've done with ONGC. But for the timing, the street is celebrating that. It's up close to around 2.5%. HICAL is up close to around 4%. And the volumes are very, very high on that one. I'm not sure what's going on there. But big move is what we're seeing out there. Godavari Power and Ispat. Favorable news coming in there. Capacity going from around 2.7 million tons to around 4.7 million tons. Stock marginally up close to around 1.5% or thereabouts. What's coming for profit taking? Grow is actually coming for profit taking. Stock is down close to around 4%. So that one, actually, the volumes are quite high for the first few minutes. Ola Electric is another one. Remember, it went dancing away from around 35-40 rupees all the way to around 70 rupees. It's back at around 37 rupees. So that actually is coming for profit taking. Biocon, I think there was some news flow that came in overnight. That one as well is down close to 2%. Volumes quite large. Net, markets down marginally. Mid-cap index trading in the green. But the Nifty Bank, that's down 100 points. The rupee, though, can't get your eye off that. 90.4 on the rupee.
Well, it's holding around the lows, right? I mean, there's no big push. And over the last 2-3 days, what we've seen is there is some, I'm assuming the RBI steps in, provides dollars at some point during the day. And it pushes it back. But for now, 41 was the low and we're at about 38, so not very far away. Ashwini Agarwal is with us, founder and partner, Demeter Advisors. Ashwini, good to have you with us here. Thanks very much for joining us. For viewers who are watching at what's going on with the currency and with the equity market being slightly sideways and a lot of damage in broader markets, how should they take the rupee depreciation, which is kind of the new dynamic? It was holding above 88.80 2 weeks ago, and now, of course, I mean, it's raced away to almost 91.5, 90.5. What's your perspective?
Morning, Prashant. I'm not an FX expert, but I'll give it a shot. So essentially what's going on in my view is the capitulation that typically happens, whenever we've seen a sharp correction in the INR versus the US dollar, whether it was 2013 or, it was, previous bouts of significant devaluation. You see a situation where everybody panics, the importers panic, there's speculation that goes on, and it pushes the rupee to an unsustainably low level, and then it kind of climbs its way back. So this time around, what's happening is that the deal with the US on tariffs, which was expected for several weeks now I think the hopes have faded somewhat. People hope that the deal will happen, but I think the confidence around that has waned a little bit. And I think also the interest rate dynamics are feeding into the exchange rate, in the sense that there is a general expectation that RBI will cut tomorrow by 25 basis points. And even though the US dollar or the US markets are expecting a 25 basis point cut in the US as well, I think the lower interest rate is hurting the rupee outlook. And last but not the least, foreign selling continues unabated. And that, I think, has to do with the fact that Indian growth in earnings has been quite tepid, and foreign investors are probably raising cash from secondary markets to participate in primary markets, where the paper flow continues to be high. So there are a lot of kind of intermingled dynamics here. I mean, I'm not sure, what RBI wants to see as a stable level before they participate. And I don't know what they feel about the reserve situation and how much they want to spend to defend the rupee. And these are hard calls. I mean, I think, I'll just leave it at that. I think for equity market investors, what it really means is that anybody that's long dollars in the revenue stream with no significant costs in other currencies. And I make that as a point because the dollar has been depreciating versus other currencies. So if you're an importer from China exporting to the US, you're squeezed on both sides. You're squeezed on the cost side as well. So some of the net dollar receivers on the revenue side is probably going to have a sentimental tailwind, which is why what we are seeing in IT services right now. So that's about it, I guess.
Okay. All right. That's on the dollar rupee. Hi, Ashwini. Great to have you in. So I wanted to discuss pharma because some interesting developments taking place here last couple of days. Wockhardt, announced further regulatory approvals for its antibiotic drug that could be well over $1 billion. That's what the company feels in global sales, Zynic. And look at Sun Pharma. Sun Pharma Advanced Research is up almost 20% because, again, there's a favorable US court ruling that gets them what is known as this PRV, which is basically an incentive for developing, less attractive drugs. So it's an incentive. You can either use it yourself or you can actually sell it in the market. Something like the TDR that we have here in Mumbai in real estate. So anyway, I mean, there's a slight favorable news flow coming in. Biocon is now looking to attract some capital, perhaps. We're in a defensive sort of a mindset in the market as well. So does pharma make the cut for you? And if yes, then what kind of companies?
So great question. I think, what has happened is that some companies in the last 10, 15 years have spent a fair amount of money on novel drug discovery. Sun Pharma, for example, has done a little bit of novel drug discovery via Spark. But they've also done a lot of buy and process type of deals to build up their specialty portfolio in the US. The other name that comes to mind is Glenmark, that has had a significant success in out-licensing a novel drug. And then you spoke about Wockhardt Zynic, where the application has been accepted by the US FDA. I don't think it's an approval, it's an acceptance, and the approval hopefully will follow in due course of time. Now, what this indicates is that the Indian ecosystem in pharma is now getting to a point where companies are willing to put serious money behind drug development and drug invention and drug development, which I think is a very, very positive sign. And you have 3 companies now having demonstrated some success. And that, I think, is a huge positive in my view. So from the export side, I think I continue to be positive on some of these names where you have a differentiated portfolio or a differentiated go-to-market. And then in the Indian space, again, you have to look at differentiated companies to benefit from this defensive stance. Now, let me explain what I'm saying. In the local market, what I see happening over the next decade is a significant shift towards generic. And to my mind, that is an opportunity as well as a threat, because the kind of premium some of the brands get today may come down significantly, or at least the share of branded pharmaceuticals being sold in the overall pie might shrink. So, I mean, in the Indian landscape or in companies where the domestic revenues are concerned, you will see a shift from the premium unbranded generics to more generic generics, and that's something that you have to bake in. So it's a bit tricky, but you can do it. So there are select opportunities out there in pharma, and as a defensive play, I agree with you that that's a place to hunt.
All right. Hi, Ashwini. Morning. Good to see you in. What are you making of the real estate market? On a health front, a lot of calls with regard to pollution. Oof, what's going on there? Hopefully that settles down. But I think you have been positive on REITs, if I remember correctly. And you had said that that's the better way to play it.
Yes.
Real estate stocks have seen a big correction from the top. Do you still stick to that REITs, or do you think now post this correction, maybe you could look at the core real estate stocks itself?
So, Nigel, great question, because, REITs appear now to me as reasonably valued. They were very undervalued 2 years ago, and they were relatively undervalued even 6-8 months ago. But now they are no longer undervalued. And they're a play on commercial yield more than a real estate itself. So, you're really buying into leased office space and taking those cash streams and viewing it like a hybrid, a growth come yield product. So, for a risk averse investor trying to build income streams, that is a very good alternative with potential for appreciation, because most of these REITs were trading at discount to NAV. Today, that's not the case. But real estate stocks have come off, like you rightly point out, and that makes things interesting. The market has consolidated thanks to RERA and thanks to the stringency that both regulators and investors and banks have brought to lending practices in this space. So most of the big players will be survivors. Having said this, I think the only thing that bothers me is that most of the development is happening in the super premium luxury space. I mean, that's what's dominating the headlines, and I'm kind of a little gobsmacked as to how many people can afford to buy 100 crore homes. I mean, so that kind of leaves me scratching my head as to what's happening to the mainstream real estate market. And typically what we've seen is that in economic slowdown, and if markets don't do well, real estate tends to follow. I'm not sure whether this is the case this time or not, because typically real estate cycles are 7-8 year cycles, and this bull cycle began in 2001, 2002. So we are relatively early in the cycle. But I think I pointed out kind of some of the advantages and disadvantages, and with the price correction, there might be opportunities out there. So that might be a place to hunt as well.
I just want to...
So Surbhi, just to come in, I don't know, the 100 crore homes, I'm very satisfied in the home that I'm currently living in. And going by the rupee, next year's overseas trip as well is cancelled. It has to be domestic.
On affordable homes, Ashwini, I'll tell you this, maybe I'll forward you that report. Since you mentioned you don't know who's buying these houses. Yesterday, one of the real estate consultants came out with a press release and a report. And I saw the title and I think I somersaulted in my chair. This was Collier's saying most tier 1 cities see notable improvement in average affordability levels since 2010. So yeah, I did a somersault in my head. I'm still trying to go through the report and I'll share it with you. And we'll see if it convinces us that indeed housing has become more affordable. But
just off the thing, right? Why 2010? Obviously, it'll be better than 2010, right? You should look at it over the last 4 years, 5 years.
See,
why is 20? I mean,
so
50.
Apparently we can afford houses.
So you're basically saying that the average pay is up a little bit compared to 2010?
I couldn't go beyond the title
true, right?
and the first 2 lines of the summary. I mean, I just kept staring at it. So I'll tell you when I read the whole report if it makes sense.
I think Ashwini is saying something. Ashwini?
That would be true. Like from 2010 to today, appreciation in real estate is probably much lower than nominal GDP growth rate. So arithmetically, that would be true. Affordability is better
what.
today. Yeah.
So since we're on the subject, I have the report open. Average affordability measured by the average housing price to income ratio. That ratio has improved from 88.5 to 45.3 in the last 15 years. Ratios are fine. At the end of the day, you go with a check and try and buy an apartment in Delhi or Mumbai. Good luck. I don't know. I have not been successful. So it is what it is. But Ashwini, tell us, in this sort of a market, leave us with your overall broad thoughts. Next 6 months, we're entering a new year as well. Do you feel that momentum and that action is going to come back in the broader markets as well? Or do you think we need to just, prepare for more consolidation and then hope for more stock-specific ideas?
So, Surbhi, I'm going to say something which I hope I won't regret, okay? I don't think I have been able to find a lot of bottom-up opportunities over the last 12 to 15 months. Okay, but in the last 3 months, I'm starting to find a lot of interesting bottom-up opportunities which give me a reasonable IRR. In terms of an outlook, and not baking in excessive optimism either on valuations or on earnings outlook. So I think the correction in the broader market, especially stock-specific real estate names, for example, you pointed out, offers an opportunity from a medium-term perspective. Now, I have no idea what the market will do in the next 3 months or 6 months or possibly even a year. But if one were to buy some of these names and hold them for a 3-year period, I would venture to think that you'll do reasonably well with a mid-teens kind of a return on a conservative basis. Now, I think there are a lot of ifs and buts because I think, the US looks a little, in an iffy place, especially with all the noise coming around AI investments being ill affordable. I think in India, we have a challenges cut out, assuming that the US trade deal doesn't materialize. So I think we have to navigate these challenges, but I think medium-term outlook is good. So I feel a little more constructive today than I did a year ago, and that's a thought I want to leave you with.
Relatively sort of more constructive in that sense. Thanks very much for joining us, Ashwini. Really appreciate your time here, and good speaking with you as always. Biocon is what we want to focus on next. Ekta is here. With, of course, the announcement yesterday, post-market hours, and what it means for the listed companies. Ekta, take it away.
Well, yes, for Biocon, it is in focus, and the buzz was on from yesterday itself that there could be a board meeting with regards to Biocon on what they could announce when it comes to Biocon Biologics as well as Biocon. Now, the board meeting they've announced to the exchanges will be held on 6th December, which is Saturday. So they will be considering a few things. So first is the investment in Biocon Biologics. That's one of the key things. And that would be by way of purchase or acquisition of securities from shareholders of Biocon Biologics. And secondly, they will also be considering fundraising, which is raising funds via QIP, rights issue, preferential issue. And remember that all of this boils down to the debt that Biocon has on its books. Biocon has around $1.2 billion in terms of debt on its books. And there have been a lot of considerations in terms of what they could look at going forward in terms of the steps for Biocon Biologics. So one of them was constituting a committee to also consider the merger between Biocon and Biocon Biologics. That is something that they spoke about, could be possibly announced even by the end of this year. So we could probably hear on that in tomorrow's board meeting as well. Remember that Biocon has been raising funds continuously. They raised 4,500 crores via QIP just in June 2025. They've been selling stake. They sold worth around 686 crores in terms of stake in December 2024 in Syngene, and in Feb 2023 worth around 2,240 odd crores, and in September of 2022, which is the year that they struck the deal with Viatris on the biologics business, they sold 5.4% stake worth around 1,220 odd crores. So the fundraising continues. Kiran Mazumdar-Shaw has indicated to us multiple times that as a company, they are very committed in terms of reducing that $1.2 billion debt on their books, and hence all these steps are probably in line to do that.
Okay. All right. Got that, Ekta. Thank you very much for giving us the details on Biocon. The stock continues to be in focus. Let's move on to our first management conversation on the show. Then Indian Railway Finance Corporation is in focus after it has returned to the external commercial borrowings market after 5 years. The PSU has raised about 300 million in yen from Sumitomo Mitsui. We have with us Mr. Manoj Kumar Dubey, CMD of IRFC, and we want to focus on three key points. One, of course, is the whole thought behind returning to the ECB market and what it really means for the cost of funds. And we want to understand what the asset diversification can spell for IRFC's margins, because they're looking at many more segments beyond just the railways when it comes to financing now. And finally, we'll get a check on the disbursement guidance for FY26 as well. Mr. Dubey, thank you so much for joining in. So let me take up the first point. You're going back to the ECB market and raising loans in yen. And so this is very interesting at a time when the general expectation is that interest rates in Japan will actually rise, or could actually rise, because of what's happening with inflation in that country. Just tell us how this makes sense for you. What will be the cost of servicing this debt? And what happens to the currency risk? Because, this borrowing is happening at a time when the rupee is, sliding to past 90.
So, morning, Surabhi. There are a few corrections in the beginning. One that we are re-entering into ECB market only after 3 years, not after 5 years. And two, this loan is for $300 million worth of yen that we signed day before yesterday in GIFT City. So, we have a very long relation with the Japanese banks for raising ECB loans. And yes, yen is a bit fluctuating currency. But, once the rates go high in that side, the hedging cost comes down. So, we have our own experiences and we feel that going forward, with the kind of hedging cost optimization, we feel that this is a very, very good opportunity to put yen also in our mix of borrowings.
Okay, so now that you're back in the ECB market, what is the cost of this borrowing, the yen borrowing that you've done? How does it compare with your blended cost of borrowing?
Yeah, so I won't tell you the rates, but as we have come to know that in the year 2025, this is the best ever rate that we have got by anybody who has raised the yen in the market. So that is a reinforcement of the fact that our zero NPA status and the kind of the fact that we are lending to the government entities, not limiting to railways now, still commands a very good respect in the lending market. A. B, to share with you, we are also opening one more bid on 8th of December itself for 400 million worth of dollar yen. So we are a little bullish on this regards for the fact that our disbursement have started now, picking up the pace with more than 50,000 crores of assets already being signed. So we want that in a healthy manner, 25% to 35%, 30% of my borrowings would come from the ECB, and right now we are focusing mainly on yen as one of the foreign currencies.
Sir, but how does that make commercial sense for you? If you could help us understand, because interest rates here in India and the expectation is maybe we'll still get some kind of rate cut. So I'm just trying to understand how borrowing in yen makes commercial sense versus, say, rupee loans here or loans elsewhere.
The AAA bond market here or the bank rates that you are getting here, and of course taking into account for the fact that there may be a repo rate cut also again. For 5 to 10 years tenure, we feel that with the hedging cost, the lending will be around somewhere between 6% to 6.2% from the yen also. So that makes sense for us. We cannot put all eggs in one basket. So we feel that for the longer tenure, with all the things taking in together, this will be a very lucrative and attractive mix in the total basket that we are trying to create.
Oh, okay. So hedging costs and all other costs put together, the cost of borrowing in yen should be around 6.2.
So it should, yes.
Okay, and you said that you want to shift almost 20 to 25% of your borrowings to the yen over what period of time?
Not yen really. The kind of mix that we create in the total mix, nearly 50% kind of thing we go for domestic bond. Another 20% to 25% we look for lending from the banks. And the next 25% we always try to have the ECB kind of mix. And dollar is also one of the preferred currency. We'll have a look on that also. But right now we have done our own calculations, and we feel that to start the ECB market, yen is a better buy for us, having all our experience in the last decade or so. Number two, we also came out with zero coupon bonds successfully in the market. In fact, we mopped up around 3,000 crore. We are the first in this calendar year, which is ending now, to successfully have mopped zero discount bond, which came out at 6.8%, nearly 35 bips discount to the domestic bond rates. So we are on now on our targets of mopping up funds for disbursement, which is picking up for my company.
Speaking of disbursements, sir, let's talk about the business overall. If you could just tell us now, how strong is the second half looking? Where do you finally think you'll end in terms of the overall growth of the book, growth in disbursements? And what is the plan of growing the newer segments? And you want to get into so many segments, logistics, ports, renewables, so on and so forth. So just give us some perspective.
So as we discussed in the last two con calls, after con calls when we came to CNBC, so we are on the right track. So what we spoke about, we are walking our talk. So end of the Q2 or H1, we first had a very healthy order book with us. We sanctioned and signed agreement for more than 50,000 crore of worth assets, all in the government parlance, including CPSEs and state government entities who are doing very well. And now we are focusing in S2 more on disbursement, as we have given a guidance of 30,000 crore disbursement in this FY, which we are right on track. So, and for precisely for that only, we are raising funds from the market, domestic as well as the foreign markets. So I reiterate our guidance that we will be ending up more than 30,000 crore of disbursement this FY. And so far as our guidance for 60,000 crore of sanctioned assets, we are already near to finishing that in this month itself. So we believe that by Q3 we'll be overshooting the target that we gave ourselves for sanction of the estimates. There are a lot many things, as you rightly mentioned, is coming in terms of metro railway assets, port assets, multi-modal transport assets, logistic assets. And we feel that with the kind of attractive rates that we are offering to the market in the government sector parlance, we stand to gain a lot of business coming ahead, maybe in Q4 as well as in the next 2-3 years. There is a very clear-cut visibility of the businesses lying on the plateau.
And with this diversification, if you could just tell us, say end of, now this year is almost going to get over, but say end of FY27, what will your asset book look like? What will be the mix? And as you keep diversifying, what should we expect on margins? How will the margins improve from the current levels?
So that is the most important and sweet spot that this company, as you rightly mentioned. You know, all last 40 years we were doing business with Indian Railways on cost plus model where my margins was only 40 bips. Now the business that we're doing in diversified mode in the government ecosystem itself, my margins are more than 100 to 150 bips. So NIM is going to show continuous improvement every quarter, as I've been telling in all my con calls. We are already crossing 2% of NIM compared to 1.4 for the old assets. And we believe that with the margins that we are getting, despite being very competitive and bidding the bids where almost everybody, right from the banks to NBFCs are participating, because we historically had 40 bips margin business, 120, 150 bips margin is very good, and my NIM will be showing continuous improvement for 20-25 quarters, I can say you.
So for your new assets, your NIM is already, you're saying, touching 2%. But at a consolidated level, your NIM is about 1.5%. Where will the net interest margin be by the end of this year, sir?
So, you know, 90% plus of the assets are showing are having a NIM of 1.3 to 1.4. So, on overall basis, my NIM will be growing in this line only from 1.4. We have come to 1.5. Maybe we end up at 1.6 or 6.5, 1.65 overall. But we have two segments now. One is the railways, where the NIM used to be 1.4, 1.3 to 1.4. Two, the new assets that we are adding, they will be having a NIM of more than 2%. So, taking two together, slowly, when the diversified assets will be having more of the percentage, overall NIM will be showing a very steep increase going forward. And that is why I mentioned that for many quarters going ahead, my NIM will be showing a steep rise every quarter.
Okay.
All right, we'll leave it there, sir. Thank you very much, and good luck on those borrowing plans and how the mix changes. We'll keep in touch. Appreciate it very much here on CNBC TV18. Take a break. We're back. We put the focus back on the capital market space itself. K. Suresh of Association of National Exchanges Members of India and me, and Rajesh Baheti of Cross-East Capital Services join in. We reported yesterday that SEBI is working on a suitability, eligibility criteria, a paper around it for everyone to be able to access derivative trading, something which has come up in discussions earlier, but I think the thinking is firming up. We'll have both Rajesh and Mr. Suresh on it in just a bit. Welcome back. Now we are sort of shining the spotlight on the capital market space itself and derivatives trading. I mean, so much has happened, discussion papers, change in thinking over the last, 12 months plus. Sources now tell CNBC-TV18, and we put this out yesterday, that SEBI may tighten access to derivative trading with new suitability norms. There is also, one or two other things we want to talk about, but this is the crux of what we've invited our guests to talk about today. K. Suresh is National President at ANMI, the Apex Brokers Association. Rajesh Baheti is MD at Trustees Capital Services. Gentlemen, great to have both of you here. Thanks very much for joining us. Rajesh, I remember, we've kind of talked about this earlier in the past, and correct me if I'm wrong, what I remember is you being in favor of something like this when there was, talk of doing other stuff. You said maybe eligibility criteria perhaps is a better way to go about this. Your first thoughts?
Yeah, absolutely. Between the two, like tweaking of products or reducing the number of expiries and putting in an eligibility criteria, I was always favoring the eligibility criteria. But I think SEBI has gone on an overdrive to deny many, many rumors surrounding this after the changes they have introduced. And we clearly see that the exchange volumes have moderated, brokerage incomes have moderated. So I don't know whether this is the right time to go ahead and push for further reform or wait for the new data to settle, look at what's happening, and then probably come out with a paper. Because even though SEBI has conducted a study that says that 90 or 95% of retail loses money, it's very important to understand what part of that retail it is. Are these the people who have no other savings and then these people are betting their salaries? Or these are the people who have other savings, have the necessary wherewithal to bear these losses? So I think they should do a little bit of a deeper study before coming out with a criteria that can hurt the market rather than target what they want to target.
I remember you having kind of sort of, at that point when this was discussed, you had some certain threshold in mind. I mean, what you thought perhaps is appropriate, etc. But what you're saying is, well, this is the way to go, but maybe not the right time, given that volumes, etc., have already fallen after what is done, what has already been implemented, right? Maybe
absolutely
give it some time.
You need to, give it some time, let the market settle, and then maybe understand what part of retail is actually losing money, and make sure that you're not targeting the entire market, because changing of the products and expiries targeted an entire market. It didn't kind of hit only retail or what they wanted to do. So this time you have to be very sure who your target is, and therefore what you're trying to reduce doesn't kind of hurt the market in other ways.
Yeah. No, in a related way, there is the other sort of aspect as well. Mr. Suresh, ANMI has written to SEBI on restoration of Bank Nifty weekly contracts.
Yeah.
So while we are talking about more steps, and Rajesh kind of says that, well, maybe now's not the time, you're asking to give what they've already done a relook. Restoring Bank Nifty contracts. Tell us what you've written to SEBI. What's the crux of the argument?
See, the argument is on many counts, actually. First of all, there's a disruption in the volume of business. As Mr. Bharati said, to the extent of 45% dip in the options volume, which indirectly or rather directly affected the broker's income. I think we must also keep in mind that broking also an industry. We are directly, indirectly giving employment to many people. We are also adopting technology. So that way, we are supporting the whole ecosystem. So here we have to see that the employment at stake because of revenue reductions. So we have to think from that angle also. Second thing is that Bank Nifty is one of the, what I can say, best instrument available, that to weekly expiry for short-term hedging. It was available. When it was abruptly removed, what happens? Once again, there is a disruption in these strategies by the traders and others. I mean, you have to spend huge money if you take a long-term contract instead of going for a weekly contract. So like that, there is another disruption in these strategies of the traders also is there. NB always feels that there is room for educating the people instead of putting the rather making everything stopped. What we advocate is that we must educate the investors so that, particularly for F&O's segment, so that there will be an informed investors who will come and play and do something for their purpose. Otherwise, this will lead to a lot of problems. Once again, from SEBI angle, we are agreeing with them that 96% of the people are losing.
Mr. Suresh, is this just a letter? Have you had discussions with SEBI officials on this?
No, sir, yet to. Only we have sent a letter and we are yet to receive a call from SEBI on discussion.
Okay, it's just a letter, which went out about a month ago?
Yeah, roughly around 15 days, I think, 20 days back. 20 days.
Rajesh, you want to sort of comment on this? Because, I mean, all of Mr. Suresh's points, of course, are valid, but, there's also the larger picture which one is to take a call on, and I guess that's why regulators are there. I mean, I guess regulators were worried about this entire almost gamification with real consequences in the option space, weekly options, etc. So just your thoughts.
There are two issues to this. One was SEBI said one expiry per week per exchange. And then SEBI said one contract per week per exchange. If SEBI had just said that let's have one expiry per week per exchange, then NSE would have to, assuming that Bank Nifty was not removed from the weekly contracts, would have had to expire both the Bank Nifty and Nifty on the same day. And let's say I have X capital and I want to use it on a 0 day or whatever SEBI is trying to stop. I only have that one opportunity 1 day a week on the NSE, and I can do it either on the Bank Nifty or Nifty. So to that extent, I think stopping the number of contracts was not such a great idea. Maybe you would have achieved exactly the same result by just saying one expiry per week per exchange. You can expire any number of contracts you want to during the same day, so that a capital can only be used once. You can either use it for this contract or that contract. And to that extent, I think would have had better diversification of risk across markets. So I agree with Andy that Bank Nifty can be reintroduced, but perhaps not on a separate expiry day. If SEBI wants to control the volumes, you have to merge it with the Nifty expiries.
Yeah, we haven't heard the last of it and whether, there will be some change on that or not, because the indication that one also got was that obviously the NSE, and we spoke with the NSE officials just earlier this week, they were saying that why not look at reintroducing Bank Nifty, because obviously it's a product that was very widely accepted in the market. So let's see what happens. But gentlemen, to wrap this up, if I were to ask you, because the objective is to reduce what the regulator feels is excessive and harmful retail speculation, but then, you have to keep brokers' interests in mind, stock exchange interests in mind as well. Rajay, if I could ask you, if there is to be some sort of a threshold to limit, retail from indulging in what it doesn't perhaps really truly understands, what sort of a threshold should be thought of? Right now, they seem to be indicating that maybe, have a certain large cash position. Only after that can you enter into F&O. I don't know if that's the right approach. How should this be done?
I think that, the discount brokerages will be having the data to understand what's the lowest rung of the market that is trading in F&O. Do they have equity savings or not? I would just kind of speculate and say if you could bring in a criteria that says you must have 5 lakhs worth of capital market savings and either by way of direct equities, mutual funds, or whatever, And then if you maintain that, you can trade in the F&O. Perhaps the lowest rung that doesn't have savings but just bets his daily or weekly or monthly salary on buying options on expiration days and treats it as a lottery, maybe that can go out of the market. If that is what the aim is, then this would work better than restricting products. And I've said that for some time, that given a choice between the two, I would have gone for this product suitability or some kind of a savings in your bank before you were able to do this.
Yeah,
but you've done the other bit.
So don't restrict products, maybe bring in a threshold. Say you have an actual underlying cash portfolio of a certain level, and only after that you can get into F&O. Though I don't know if that really meets the objective, because it's not like their underlying cash portfolio is or can be used as collateral or margin. Not necessarily, may or may not be the case. Mr. Suresh, final word with you. What would you recommend? What kind of thresholds will be palatable to the broker community?
See, actually, there was an apprehension earlier that Bank Nifty is manipulated, etc. Okay, now a realignment has happened to that index. Okay, so it's well balanced now. So the room for manipulation gone. So when there's no room for manipulation, nothing wrong in introducing that. From broker's point of view, mainly, the income already reduced a great extent, and it has affected the functioning of every broker, particularly large brokers also. So from that angle, the employment also at stake for various, the manpower, rather, we are losing many people employment in that segment. As we argued many times back, many years back, that we need industry status for broking actually, because we are directly, indirectly contributing to the economy of the country. So from that angle, my view is that reintroduction of Bank Nifty is a must for bringing back the necessary hedging instrument, as well as bringing up the volumes and also providing another variety of product for the investors as well as for the other players in the market.
Okay. All right, gentlemen, we'll leave it on that note. Let's see what the final rules and guidelines and what's the final structure of the policy as it evolves. Thank you for joining us today. Well, with that, let's get back to the market and get you some trades at 10 o'clock. The market's actually recovered. We're seeing some green on the screen now, 45 points up on the Nifty. And the mid-cap index is actually doing even better, up about 0.3%. Somil Mehta is joining in. He's from Mirae Asset Share Khan. Somil, morning. So what are your trades now?
Good morning to everyone. My trades would be in banking, private banking, and on the IT side. Both sectors are looking great. I will focus more on the large caps. I have ICICI Bank. ICICI Bank's looking good. Taken support at 2040 and 200 daily moving average. Showed very good momentum yesterday. I think this rally should continue. Stop loss would be 1350 and the target would be 1500. My second stock is from the IT pack. IT pack is doing really good. TCS has just broken out of a triangle pattern. High top, high bottom formation on the weekly charts as well. Great setup. Stop loss would be 3120 and target would be 3500.
Okay, all right. Thank you for that, Somil. We'll leave it on that note. Let's move on to some stocks that are active, that are buzzing around right now. Petronet LNG is one of them. Sonal is here with more details. Sonal.
Well, yes, Petronet LNG higher in trade on the back of an execution of a binding term sheet that they've entered into with ONGC. This is for 15 years and it will include ethane unloading, handling and services as well. Petronet LNG says it will have a gross revenue potential of 5,000 crore rupees over the next 15 years. Nomura on the back of this is quite positive on the stock. They have a target price of 360 rupees a share with a buy rating. They say even if they assume a conservative EBITDA margin of 60% on this particular deal, it would mean EBITDA potential of 140 crore rupees in the first year, and 15th year EBITDA would reach around 275 crore rupees. This is as per current estimates of 60%. It could go higher as well if margins improve. So yes, it is a good deal that they've entered into, which will lead to EBITDA accretion going forward.
Okay. All right, Sonal, thanks so much for that. Well, with that, let's move on to the other big story, and that is the aviation mess that we've seen at major airports over the last 1 or 2 days. Major disruptions following flight cancellations largely by IndiGo. We have Shivani joining in with the latest details. Shivani, what's happening now?
Yes, big disruptions across the country now. IndiGo has seen a lot of flight cancellations, and what we are getting to know from sources at the Bangalore airport now is that since 12 a.m. This morning to right now at around 8 a.m., close to 72 flights have already been cancelled, and this number is going to go up during the day when we look at major airports, which is Delhi, Mumbai, Hyderabad and Bangalore. So let's keep a track on how many flights are cancelled. And as I mentioned before as well, the delay timings are averaging around 5 to 6 hours at major airports. So this is like a nationwide disruption now. In what happened last evening, DGCA, the authority, has summoned IndiGo Air, and has asked them to present themselves in front of the authority and explain what has caused these delays. So we'll have to keep a check on what happens during the day, because these cancellations are going to increase today as well, because IndiGo has said that it will take 48 hours to control the situation and manage the situation. So this is a developing story.
Okay. All right, Shivani, and we'll keep coming back to you for more updates. It is indeed an important story. Right now, we'll take a break. On the other side, Manisha Gupta joining in with the latest in the commodity markets. Welcome back. So as promised, let's figure out what's happening in the commodity markets. And we have Manisha Gupta with the latest. Manisha, what do you have your eye on?
Well, metals, and I want to talk about two metals which have hit all-time highs in the overnight markets. One is silver, which is trading at around 58.98, which is an all-time high. So 59, consider that almost done, and $60 an ounce is what the markets are watching out for right now. If you look at the overall gains in this year in the dollar terms, well, we are up by 103% for the silver prices. So the prices have doubled up from where we started 2025 there. Well, the markets are now working with the probability of almost 90% of a U.S. Fed rate cut in the month of December. November. That seems to be baked into the prices right now. And then you have the US private payrolls, which fell by 32,000 jobs. Markets were anticipating a jump of 10,000 jobs here. So not only did we not see any gains, but it is a sharp decline that we've seen in sense of job numbers there. Also, silver-backed ETFs have added 200 tons on December 3. The total holdings now stand at a 2022 highs. So this is something that was missing really, because the markets thought that ETF buying had peaked in 2022, but we seem to be closing to those numbers right now. The other thing is the record volume of silver, which seems to be moving to London in the month of November. Well, the Shanghai inventory is trading at the lowest in last 10 years. All of these factors have led silver on the higher side. I want to show you on what silver has done in sense of top yearly gains since 1979. And that was the year we saw silver prices gain up by 360%. So 2025 in that sense is the second best year on record, with 103% of gains coming in. And the other best years in that sense have been anywhere between 40 to 80%. So this year clearly on the stronger side there. This is in the Indian rupee. So if you have seen 103% of gains in silver in the US dollar terms, because of rupee depreciation in the Indian rupee markets, we have seen 112% of gains come in for silver this year. Last year was 87,000 rupees. Currently, we're trading at 1,84,000 rupees. So that's clearly a doubling of silver prices that we have seen. And this is what we've seen in last many years. Barring 2021, the last 5 years actually have given you positive returns when it comes to silver prices. And as you can see, doubling in case of silver prices, 112% of gains in Indian markets for silver in this year till time. And we still have much of December left there. The other commodity I want to talk about is copper. That also has hit an all-time highs in the overnight markets. 34% of gains in 2025 till time. An all-time high has been $11,400 a ton. Well, there have been warnings of low global inventories coming in from companies, agencies, banks and brokers as well. And then you have large quantities of copper being shipped into US in anticipation of tariffs going forward. The producers also have announced record premium to their customers in Europe and Asia, and that has been keeping prices much higher with this part of the world. If you look at the mine outages that we've seen in Chile, Indonesia, Congo in this year, that have led to gains in copper prices. And then even now, as we speak, the Chinese smelters and miners are locked in conversation about supply for 2026. All of those factors clearly very supportive. And then when you look at the overall orders for copper, they are the largest since 2013. So whichever way you look, that is whether it's about demand, supply, inventory, mine outages, copper perhaps is the place to be.
Okay, all right, Manisha, thank you very much for that. We'll take a quick break on that note, come back on the other side, and we'll have our special segment, It's the Economy. Today, Lata discusses the outlook on the Indian rupee with Kamaksha Trivedi of Goldman Sachs.
Welcome to It's the Economy. Another day, another low for the rupee. The Indian currency touched 90.40 to the dollar earlier today. Yes, it has been the worst performing currency for a better part of 2025, but the 2% fall in the past 2 weeks has been particularly shocking. The Reserve Bank appears to have taken a more hands-off approach. In that case, where do we see this rupee headed? 90.40 today, is it worse? I have with me someone who has tracked the currency for a long time, Kamaksha Trivedi, the head of Global Forex, Interest Rates and Emerging Markets Research at Goldman Sachs. Kamaksha, thank you very much indeed for joining us. I know it must be a tumultuous day in the dealing room. To cut to the chase, it has been a slow grind for the rupee. First up, how do you explain this sudden collapse, over the last 2 weeks?
It's been, quite a steep, move in the rupee, certainly weaker than we had anticipated. I think there's a couple of things going on here. I think the fact that, after a little bit of a better inflow picture into Indian equities in October, you've seen a little bit of a flattening out there. I think there was some anticipation built up that a trade deal with the US was imminent. That's obviously been, those expectations have been tempered somewhat. And I think equally on the other side, I think you've seen a shift in, the policymakers, the RBI's management of the currency. There definitely seems to be a greater willingness to accept volatility in the rupee. We've talked about that in the past. I think that's broadly a healthy thing. But I think what you've seen in the last couple of weeks is that tolerance for greater volatility, certainly on the weak side, seems even greater than we had anticipated.
Okay, I'm still looking for reasons for the recent sharp fall. Kamaksha, the fall was sharp on December 1st. That's on Monday onwards. Is it because on that day, the Reserve Bank released the second quarter BOP numbers, balance of payments data, and then we knew that the current account deficit for Q2, September quarter, has spiked to 1.3% from just 0.3% in Q1. Do you think this data has triggered a fear that external factors are way weaker than we thought?
I think that is, not just a fear. I think it's the reality. I think that the tariff hit against India has been, worse than, many people anticipated, more than we anticipated, certainly at the start of the year. The trade deal, like I said, I think there were some expectations that it was imminent, perhaps, even something that, ministers and others sort of pointed out, that sort of pushed back. And while that is happening, you've seen weakness on the external side. You mentioned the current account, that's certainly been weaker, but it's also been something that's visible in the forward-looking survey data. New export orders, for example, in the manufacturing survey that just came out, the PMI, that's one of the weakest it's been in the last several months and quarters. So this is having an impact. There's no question about that. I think currency weakness is one way to respond or one way to adjust to kind of that type of external shock. That's part of what's playing out. And I think the inflation picture, Lata, I think is also playing a role here. I mean, currency depreciation can be quite costly if it comes at a time when inflation is high and above target and accelerating. So I think the fact that the inflation picture looks pretty benign right now, that might also be giving more confidence to policymakers, the RBI, that they can allow a bit more currency weakness to offset this tariff hit, to adjust to this current account weakness that you mentioned without taking risks on the inflation side.
No, actually, I don't know, maybe you heard the CEA, Chief Economic Advisor, yesterday. He said exactly that the rupee's fall doesn't give him sleepless nights. And that's because he said this is the best time to let it fall. We are not worried about imported inflation considering how low CPI is. Now, with this let go of approach, the rupee at 90.30, 90.40, do you think it becomes a screaming buy, not just from RBI, but from the market?
I think that, you have to think about the starting point here. The rupee was starting from an overvalued level a few months ago and certainly a year ago, and we've essentially eroded all of that overvaluation in real trade weighted terms, and now you have, a small undervaluation. It's a small undervaluation. It's not a big one, so I don't know that in and of itself, that or the 90.3 level is sufficient to get, people come back in. I think the overall sentiment and, needs to change. But I'm quite optimistic. I think that the underlying macro picture in India is less negative than the sentiment suggests. We just had a bumper Q3 growth number. Inflation is pretty low. What is true, however, is that those positive macro fundamentals, notwithstanding the current account weakness that you mentioned, is more likely to show up in equity prices, more likely to show up in the fact that equity markets, start to perform again. That's our expectation. We have upgraded India equities after a year. And so I think slowly as those inflows start to pick up, I think they will find their way into stabilizing the rupee. But I'm not sure that 90.3 is the line in the sand where people come back in, just because the undervaluation is just not deep enough yet.
Your own forecast, I read a Goldman Sachs report of November 28, and that report said that the rupee will appreciate to 87.50 in 6 months and then to 86.50 in 12 months. Now, will you guys rethink your forecasts?
I mean, if you look at the way, at least the spot exchange rate has behaved over not just the last few months, but over the last, I would say 5 to 10 years, you tend to have essentially these bouts of depreciation and then a kind of stability in the dollar INR cross rate. And that stability relative to inflation and relative to the rest of the currency complex is part of what contributes to the kind of real appreciation that you saw in the currency over the recent years. So I think it's, one of the things that we will have to see, and, we'll see the revealed preference here, is this new regime with higher volatility, something that even the IMF recognized in its change of classification, is that a two-way volatility in the currency? So is dollar INR, does it also go down like it, went up? Or do you have essentially more volatility one way, which is on the way up, but then you go back to that kind of stable path going beyond? And I think that's the real question over here, which is that, the macro, as I said, I think is I'm pretty optimistic. I think if you get that trade agreement, I think that there's, fundamental grounds for the equity market to do better, for earnings to pick up, for inflows to come back. But I think the important question at that point is this new regime one where, you also see a kind of a move lower in dollar INR, or just a kind of stable move? I think given past behavior, I think stability is more likely than a sharp appreciation of the kind that we had forecast.
I would agree with you there. First of all, RBI will want to buy dollars to replenish their reserves. As well, in a trade war regime, it's good to have a cheap currency. But let me come to the most important near-term question, the most important. Do you think the rupee's rapid fall will weigh on the Reserve Bank tomorrow when it makes its policy and, prevent it from cutting rates?
I don't think so, to be honest. I think that there is room here to ease policy. I think inflation, not just in its last release where headline inflation fell to one of the record lows, near 0%. But I think just generally inflation has been reasonably benign. I think that, a rate cut seems appropriate here. And I think, the weakness that we've seen in the rupee, while, it feels, pretty bad in the last week, in the last few days, as I mentioned, only brings back the rupee to a modestly undervalued level on a real trade-weighted basis. And it comes against a backdrop where the current account is weak. India has faced some external shocks. Tariffs are high. And so a weaker currency is the most natural way to adjust to those shocks. I don't think that should stop the RBI from cutting rates. We think that they will cut rates. And so I think, I don't think as of now the moves we have seen yet are a cause to really halt that cut.
Okay, let me dwell for a bit on the other central bank, the Federal Reserve. Your report also said that you'll expect about 3 cuts from the Federal Reserve starting in December itself. What will that do to the dollar? The DX actually has fallen today. So what do you think will happen to the dollar?
Yes, we expect the dollar to weaken further. If you again step back, the dollar came from a situation which was very highly overvalued at the start of this year. And what we've seen is that the U.S. economy is no longer as exceptional as it was, compared to last year. U.S. markets have not been as exceptional as compared to last year. It's been a much more balanced global growth profile across the world, a much more balanced equity return profile across the world. And that means that the dollar's high premium, the dollar's rich valuation needs to erode somewhat. That's already happened. We think more of that will happen as the Fed cuts further, as the weakness in the labor market becomes more apparent, as you get the new data following the shutdown. Both of those forces, alongside that more balanced global growth profile, should push the dollar weaker from here. We think, another, 3-4% in trade-weighted terms is a kind of reasonable expectation over the coming 12 months.
Okay. Speaking of interest rate differentials, let me come back to India. We have seen some 17 billion of equity outflows by foreign equity funds, but bonds have actually seen an inflow of $8 billion in 2025. Do you expect bond funds to be attracted now that the currency looks cheap and Indian yields are still high?
I think there is India is an interesting market for global bond funds. I mean, I think, and particularly so within Asia for some of the reasons that you mentioned. I think when you really zoom out across broader emerging markets, the truth of the matter is there are some other places which look even more attractive than India, right? I mean, you have places like Brazil with, 15% policy rates and, 4% inflation. There's a start of a sort of big cutting cycle that can come in Brazil. You look at, again, South Africa, they've had sort of, some structural shifts in their inflation target. Obviously, the bond market has performed very well already, but I think, global bond funds are, very much involved there as well, reflecting and playing for the flattening of the curve there. I think the opportunity in India is there, but it's somewhat smaller, for example, relative to some of these other markets, but it's bigger compared to the lower yielding parts of Asia. And so I think there's definitely going to be interest. I think the sell-off in the rupee, given the carry that you mentioned, I think, on the margin adds to it. But I also think you need to get past some of these risk events. I think people will feel much more comfortable getting back into Indian bonds, into Indian equities. And we've seen a little bit of that. As you said, there's been lots of outflows of Indian equities, but there's been a little bit of a pickup in October. I think as you get past the risk events to do with the tariff, spat with the U.S., if you get to a better place on that, if you get to an agreement on that, I think people will return to Indian markets quite swiftly.
That's the whole problem, isn't it, Kamaksha? We've been waiting for this deal and waiting for this deal. Now, let us hypothetically assume the deal doesn't happen soon. Not in a month, not in 2 months, not in 3 months. Will foreign investors continue to shun India? Is this deal such a big deal?
I don't think it's such a binary event, but I think it probably will help sentiment. And I think, it's not just what is going on with respect to India. I mean, global investors have a choice. And so to the extent that, it's leading to better trade outcomes and better market outcomes in other parts of emerging markets, for example, China, which were a big underweight for a lot of emerging market fund managers for a long time, even as India was an overweight, you're seeing a little bit of that shift. And I think that to change the kind of sentiment dynamic, I think, the trade deal could be a kind of quite important catalyst. Without that, it can still happen, and we think it will still happen, but it's going to be a much more slower moving process. It's going to rely on earnings gradually getting better. It's going to rely on that fundamental basis for the Indian economy gradually getting better. And it is better. It is resilient, like I said, but I think it will take more time. Whereas I think something like that trade agreement, I think, could really catalyze that shift in sentiment much more quickly.
Oh, yes, we've all been hoping for that. Thank you very much, Kamaksha Trivedi, for joining us. At the moment, the rupee has just recovered a wee bit from that 90-40 level or 42 level that it touched earlier today. The feeling is that Reserve Bank may defend 90-25 to 30 for some time now. And the next line in the sand is seen as 90-45-50. They seem to be defending these whole numbers, 25, 50, 100. So 50 is the next level the market is watching out for. On that note, wrap up on Bazaar Chartbusters coming.